Well, hello and a very warm welcome to today's executive dialogue on gearing up for today and tomorrow's weather risks. My name's Anthony Kennaway and I'm the Head of Public Affairs and Stakeholder Dialogue here at Swiss Re. Now, 2023 saw over $108 billion in insured Nat Cat losses and was for the fourth consecutive year of insured losses over $100 billion. But unlike 2022, there was no peak peril like Hurricane Ian. And it was event frequency that actually drove last year's numbers, with over 140 Nat Cat loss events setting a new frequency record. And it was severe convective storms that featured most strongly in this loss experience, mainly affecting the United States, but also discernible here in Europe. So today we want to discuss some of the drivers behind the numbers and also take a look at how well equipped our industry is in dealing with these increases. So who better then to take us through this topic than our panel of expert speakers today. First of all, Jerome Haegeli, who is the managing editor of our Sigma reports, as well as being the group chief economist, who's joining me here in the studio. And then joining us virtually from the US are Krysti Adamson, who is the head of US P&C Globals, and Mohit Pande, who is the Chief Underwriting Officer Property. A very warm welcome to you all, and thanks for joining us here today.
Thanks, Anthony.
So without further ado, let's get into the details here. And Jerome, if I can, let's start with the big picture and start with you on that. I mentioned $108 billion of insured losses, the fourth consecutive year of losses over $100 billion. Give us some more color on the differences of the 2023 versus 2022.
Well, thank you very much, Anthony. Great to be here, and thanks for joining online. Well, actually, if you look back in 2023, and we issued the Sigma report 2023 just 1 month ago, unfortunately, when you look back, we have to say a number of records have been broken. Number one, we had never had so much high of economic losses and insured losses for severe convective storms, and this is thunderstorms, hailstorms, right? Second, we had seen, and you mentioned that in introduction comments, that the losses, again, more than 100 billion in terms of insured losses, and this is the fourth consecutive time. But we have seen a record number of events driving that. To be exact, 142. I mean, just think about that. We never had seen 142 numbers in terms of Nat Cat events, of low to medium severity events. And yes, number three, we are seeing again above 100 billion in terms of insured losses in dollar terms, without a peak risk. I mean, just imagine if you had a hurricane. So unfortunately, it has become a new normal to have more than $100 billion.
Okay, and so we're talking about a new normal here. So we expect this to continue.
Unfortunately, yes, we do. I mean, there are various driving factors which lead us to expect $100 billion and more is the new normal. We have seen again a confirmation that the economic and insured losses, they are increasing at a trend growth of about 5 to 7%. Unlikely that this will change. And fact is, if you look back, they were actually even a little bit below the trend growth. But looking ahead, and this is an industry first, what we did in our Sigma report, we really dissected where is the severe convective losses coming from, and show climate change is part of it, show societal changes with vulnerability of solar panels is part of it, but urbanization, population growth, and especially also inflation, and just economic inflation out of the 8% trend growth of severe convective storms, about 2% to 3% is just driven by economic inflation. So we can expect that trend to continue.
Okay, so key drivers then, inflation, value at risk, but also some climate we're seeing within the
absolutely
within the numbers then. So how do we address this then, Jerome? And maybe we'll come to you on this in just a second. But how do we build resilience on this?
I think we need to be really comprehensive, and we need to have the transparency. And there is not one size fits all, and there's no silver bullet. We need to work on risk mitigation. We need to work on risk adaptation as well as the risk transfer. We need to manage the transition risk to net zero. We need to know where we are. For that, we need transparency. That's why in the Sigma report we also have a strong call of action. Have more transparency. Have more data on severe connective storms. Knowing on the losses, it will help also to incentivize to do the right thing on risk mitigation. And where you cannot mitigate the risk with retrofitting buildings, retrofitting, also building better bridges, more adapted bridges infrastructure, retrofitting residential and commercial buildings. Yes, sure, insurance will play its part in terms of risk transfer, but it needs to be a combined approach, and transparency. Data is an important part of it.
Yeah. All right. Thank you, Jerome. Thanks to you for that. And Mohit, can I come to you on that for the underwriting perspective?
Yeah. So Anthony, I would just like building on what Jerome said there. As a first step to build that resilience, the insurance market needs to be sustainable, needs to function in a sustainable way, which requires that premiums need to be commensurate with the underlying risk. As Jerome said, the losses are increasing, which means high rates alone will not be sufficient. We will need to reduce those losses, and to reduce those losses, there needs to be more adaptation measures. Adaptation measures like better enforcement of building codes, building protective measures like flood control infrastructure, and discouraging people from building in areas that are highly prone to natural catastrophes. I would like to share a stat on that last point. If you look at the area where Hurricane Ian made landfall in 2022, the population has grown by 620% since 1970. 620% versus 65% of population growth in all of US. That's 10 times more than the overall country. So, climate with climate change in our face, adaptation and insurance will only go so far. And this leads to the point that Jerome was making earlier. Mitigation on greenhouse emission gases will offset some of this buildup in physical risk. And so I think to build that resilience, we all have to play a role. The property owners, the insurance industry, the regulators, and so do the government. The government has to incentivize uptake of adaptation and mitigation measures and invest more in resilient infrastructures.
Yeah, and I think this is becoming a really sort of global conversation now. I've seen, I think, 4 or 5 articles in the FT, a piece in The Economist about this. I think it's a really important point. Krysti, let's come to you if we can, please, because you give us a sense of what clients are thinking here.
Sure. So thank you to Jerome and Mohit for sharing, what we see is needed from an overall industry perspective. Specifically for our reinsurance client perspective, I would first emphasize the need for adequate capital. And most importantly, that the insurance capital base will need to grow with the growing risk exposures in order for our clients, the insurance companies, to continue to provide insurance solutions and provide those solutions to more people around the world. The second thing I would emphasize is collaboration, right? So together with our clients, ensuring that we are investing in the cutting edge technology, improving our modeling. This is going to enable us to continue to, 1, enhance our risk assessment, and 2, to increase the risk awareness amongst potential insureds and then society in general. So we're dedicated to working with our clients and our partners in order to help identify where these protection gaps exist, and then also from a risk transfer perspective to make sure that we're providing traditional and innovative risk transfer solutions to help our clients close those gaps and insure more people and more risks.
All right, Krysti, thank you. That's great. And then losses predominantly then, I suppose, are being driven by severe convective storms, as we discussed, mainly affecting the US. Mohit, Krysti, what does this mean for the industry? What do we do about this severe convective storm piece? Mohit, why don't we start with you?
Yeah, so Anthony, if we look back at last 15 years, the losses from severe convective storms have been growing at a rate of 8% annually. And this annual growth rate is not going to slow down as we look at the future because the drivers of this growth are unchanged. And Jerome captured some of these drivers earlier around urbanization, the economic growth, inflation, the changes in vulnerability of insured assets. And to add to that, climate change is also driving the severity of hail events, which is further adding to this growth in SCS we are seeing. Now, the good news in all of this is that our global insurance and reinsurance industry has done a really good job of coping with increasing nat cat risk. If you look back over the last 3 decades, the nat cat risk has grown tenfold. And despite this tenfold increase, the insurance and reinsurance global industry has been able to successfully add to financial resilience. Now, we can't get complacent. As we look ahead, we have to make sure that it remains sustainable. And for it to remain sustainable, it all starts with premium being adequate, risk adequate. And to achieve those risk adequate premiums, the insurance industry has to make sure that it avoids biases, optimistic biases, by anchoring in the past and coming up with forward-looking views which are more realistic. And then the last thing is making sure that the exposure information that is being captured for these property values, they reflect the current trends in inflation and reconstruction cost.
Right. Yeah. And Krysti?
Yeah, so I'd say from a client perspective, I mean, this is certainly top of mind for all of them. In the US, we just experienced a late April series of severe convective storms, which was wreaking havoc across the Midwest, the Plains, the Mississippi Valley, tornadoes, flash flooding, hail, and all of this resulted in damage to buildings, to people's homes and vehicles, and also led to loss of life. And when our clients reflect on 2023 experience, for most of the loss events that occurred, these events were actually the costliest ones to each of those areas impacted. If you take the Hawaii wildfires, costliest event for the state, you have Hurricane Otis, a Cat 5 storm on the Pacific coast directly hitting a major city. That was the costliest event for Mexico. And you have the Italy July storms, which generated the highest ever insured loss for that country. So the list goes on. And our conversations with our clients on this particular topic really center around how are all of us actively adjusting to this new reality.
Yeah.
Maybe if I can add, I want to add for one point in terms of what Mohit and Krysti just said. What is also needed, I think at the end of the day, what is needed is also we need not just to have adequate prices, right, in terms of in insurance markets, but we also need to internalize external externalities, meaning the climate change effects on the economies, on society, on properties. And unless we give a price to these externalities, the markets will not fully function. From an economic perspective, you would want to have a price tag. That's why more data is important. That's why also, if you look back in our research from the Swiss Re Institute and Sigma team, the economics of climate change, having a price on what is, what are causing, not what causing, but what is the cost, annual cost of wet perils, including severe convective storms. In the US, it's about 0.5 percentage point. It's big on an annual basis. These costs then give better incentives also to do investments. Right. I think that's why the data and the price signal is so important.
Yeah, well, on the investment side also, and I know this is a topic that we talk about a reasonable amount, maybe you and I could come back to that a little bit later, Jerome.
Sure.
It looks like secondary perils are more consistently featuring in loss experience these days. Is that how you see it? And what does that mean on the underwriting side?
Yeah, so what we are seeing is a larger portion of secondary perils contribution to the overall insured losses. That's absolutely correct. And if we look back at last 30 years, the contribution from secondary perils has grown to more than 50% of the total. And it's not just severe convective storms, it's also driven by floods and wildfires. And this trend of larger share coming from secondary perils is not going to slow down. If anything, it's going to grow as we look ahead. Again, going back to the drivers we talked about. So how do we tackle this as an industry on the underwriting side? I think the first thing is we have to continue to make more investments in refinement of secondary peril models. So there are still parts of the world where we either don't have good models or we don't have models at all. So we have to both invest in refinement as well as the coverage of secondary peril models. The second thing is the models is as good as the data you feed it. So we have to have more accurate exposure data, and that data. This goes back to what Jerome was saying earlier. This data has to be shared transparently across the value chain, so everybody can put a price tag to that risk, which is risk adequate. And then lastly, I would say everybody in the risk transfer value chain has to play their respective roles. While the reinsurers play the role of a shock absorber by taking on the volatility from once in a decade or longer type of events, the primary insurers are better positioned and have the right tools to manage and absorb accumulation of small to medium-sized losses. And when I say the tools, these tools include rate making that can keep pace with the loss trend, property valuation models, effective accumulation control, and the ability to customize coverage options. Mm-hmm. And this is one of the reasons why the industry has seen a shift towards more balanced risk sharing through the increase in attachment points over the last couple of years.
Right. Very good, Mohit. Thank you. And the drivers underneath this, again, it's the same things, right? It's value at risk, it's inflation, and then there's a component of climate after that, as I understand it. So we're very clear.
Yes.
Yeah. Very good. All right, let's get to the questions, and maybe we can talk about investment, Jerome, in just a little bit. The first one, Mohit, probably this looks like one for you. Are there any new products or covers developed based on weather change?
Yeah, this is a good one, and I would say parametric products are the technological innovations that we are seeing, and these products are simple, transparent. They also provide a very fast payouts, and they're actually helping with closing that protection gap through public-private partnerships.
Yeah. Okay, thank you very much indeed. Jerome, let's come to you with this next one. There are many changes in weather patterns. How do you see this impacting the Middle East market, especially Dubai? And of course, we're conscious of the events, the sad events that have taken there recently.
No, absolutely. And we also had an industry event just last week in Dubai itself. And if I look at protection gaps, and we talked quite prominently about the protection gaps. If you look at Dubai, if you look at the Middle East, I would count the Gulf countries as well as Pakistan towards that. We see actually that the protection gap, so the uninsured part of the economic losses, is extraordinarily high. It's about 80% average across the markets, advanced and emerging markets, about 62%. So it's much higher. So I think insurance, definitely the protection gaps, especially for the low income, more vulnerable parts of societies and economies, plays a big part, must play a big part of it. Otherwise, you expose the private and public balance sheets. And second, yes, sure, the weather events we had seen 2-3 weeks ago in Dubai is a reminder again that also Dubai and other Gulf countries can be heavily exposed.
Yeah.
So I think that's a stark reminder that climate change is here and present. It's not just climate change, obviously, we have to be very, very clear about that. And in our Sigma report, we say it's about 1%, only 1%, which is driven as of now by climate change, but it's population growth, is urbanization, and there's a lot of wealth as wealth in these countries.
Yeah. Okay. So rising rates to cover for increase in frequency and severity of Nat-Cat events. Don't these rising rates risk unaffordability and hence increasing the protection gap? Jerome, let's start with you on that, if we may, and then sure. Mohit, Krysti, you can decide if you can let me know if you want to jump in.
I mean, sure, we have inflation, right? Yep. Economic inflation, we have claims inflation, and we have higher insurance market rates. But we also have higher wages. But clear, if insurance markets the prices increase, there's a risk of unaffordability for sure. However, if you look back, and I think Moya said that very, very clearly, if you look back, insurance industry not only managed to cope with the risk, but paid out a lot, right? Over the last 30 years, I think, in terms of the payout, it doubled. So there's a lot of increase in terms of coverage over the past decade that we had seen. And second, in terms of protection gaps, if I look at the protection gap figures, I mentioned before about 60% is the current protection gap. It's actually pretty stable. I mean, we would like to see the protection gap decreasing, but at least it's not increasing. And I think having this price mechanism, there's also an education part of it and also a knowledge part of it, having the price tag to it and also the right regulation. I think this helps. So affordability is one aspect, but it's not everything.
Right. And new products and solutions making it more accessible,
Absolutely,
I suppose, as well. Yeah. Okay. Very good. Mohit, maybe this next one is one for you. Loss creep is a big issue for the industry, especially the Italian hailstorms last year. How can we better manage this issue across the value chain?
Yeah, so I think it starts with making sure that the exposure data remains up to date and accurate. What we've seen in Italy, the loss creep, some of that is coming from the undervaluation of the properties, which only came to surface as the claims started getting settled. The other part of it was also around the use of solar panels on roofs, which have a higher cost of repair than what a traditional roof would be. And these things need to be captured adequately in the exposure data, and to my point earlier, shared transparently across the value chain. And this will help us in minimizing the loss creep or eliminating the loss creep that we have seen in the Italian hailstorms.
Yeah. Okay. Thanks, Mohit.
So maybe,
Krysti, yeah.
Sure. Can I just add there, just to both of those two questions, just from a client perspective? I mean, I would say what we are seeing our clients, so the insurance companies, is they're working with their own clients, right? The insureds, actively on risk management and prevention as well, right? So to the affordability and the protection gap, topics, I think that's something we're very clearly seeing. We're also seeing them make significant ongoing investments in the valuation of assets, as Mohit said. And this is something that's going to be continuous and ongoing, but we are seeing our clients very active in this space.
Okay, very good. And maybe Krysti, with this next question, I could stay with you if I can, please. So past information is a very important component, but what is Swiss Re and the industry doing in order to anticipate the new reality?
Sure. So, I spoke earlier about, where we need to collaborate there on the modeling. So it starts with the data, right, and the transparency, as Jerome and Mohit had shared, and then making sure that as an industry, we're all working to evaluate that and assess, how we can, further understand the risk assessment and the growing exposures. We do have some examples. I think we actually have a tool that maybe Mohit can speak to, but that does assess the protection gap in certain areas. So we try to help from an identification perspective. We also have, different data and tech innovations that support risk management and location intelligence. So CatNet is one of the tools that Swiss Re has. We also have a rapid damage assessment component of that as well. So we're trying to offer a platform for our clients and our partners to help address this and to stay on top of all of the perils. Jerome and Mohit, anything to add there?
Yeah, Krysti, I would just like to add something on hail modeling, because hail is the costliest peril of the three perils that make up severe convective storms. So severe convective storms are made up of tornado, hail, and derecho, or straight line winds. And hail is the costliest of the three in the US, but also in Europe and Australia. And it's also a very tricky peril to model, because the event footprint of a hail event is localized, complex, and diverse. And coming back to the question on what Swiss Re is doing, we are investing quite a bit in coming up with new approaches to model this event footprint for hail. Also, there are efforts going on across the industry and in academia to make sure that the event data is collected and shared so that we can benchmark these hail events. And then lastly, staying on the hail topic, while there are advancements going on the hazard part, one of the silver lining, if you can call it so, on the vulnerability side is that with all these recent hail events, we have a lot of claims data. to benchmark the vulnerability component of hail. And hopefully all this will allow us to model hail with more enhancement and refinements and get it to the same maturity level as other perils like hurricane and earthquake.
Yeah, I would just say we cannot underemphasize the importance of data for the reasons that Mohit just mentioned for hail, and that's why having better transparency, it will help. It will help to anticipate this new reality. It will help to have adequate prices. But if I look at past prices, I think they were not adequate. I think the market is more in line in terms of the balances.
Yeah, very good. And Mo, Krysti mentioned just RDA, rapid damage assessment, and also CatNet. I mean, these are facilities that are seeing increasing popularity, aren't they? Tools that we use that help clients layer data. Just give us a bit more of a sense of what we're doing there.
Krysti, you want to take it from the client perspective?
Yep.
Sure. So it's actually, so these tools sit within our solutions division, which is a division that we look to provide these services for our clients. And so, for example, on CatNet, this tool can provide, global storm surge hazard risk map. It can also give global pluvial flood risk layer. And these are the types of things that we're trying to give the details. So as our clients are assessing risk, either on an individual basis or on a bulk location basis for their clients, that they can drill down into that information to help them truly assess that risk in a better version. We continue to update the services and the tools that we provide. We also have some investments with other entities that we've brought on board and other data information. So we're trying to bring all of that together to ensure that we're providing the most cutting edge information to our clients to help them assess their risks.
Brilliant. Thank you very much. It's great. I was very impressed when I saw it, I must say, for an ingenue. Jerome, anything else from your side? Maybe a final statement?
Well, I think if you look at the Sigma research last year, the theme was the economic storm. We had a lot of inflation. The price levels are still very high. I think topic in terms of what we discussed, it doesn't go away, but having better data, having better analytical framework, collaborating with the clients, with policymakers, I think that goes a long way to improve the outcome.
Thank you very much. Mohit, a last word from your side?
I would just emphasize what Jerome just covered there. I think, for us to be able to build that resilience, it will require everyone's efforts, and it all starts with data, model, and more transparency across the value chain.
Yeah. All right, and Krysti, last word.
Well said.
Very good indeed.
Very
good indeed. Thank you for joining us and providing their insights. Jerome Haegeli, Mohit Pande, and Krysti Adams, thank you very much indeed for joining us, and thank you, the audience, for listening. Goodbye.